don't want to, I want to look at, well, can we? Okay, it's 10 o'clock. Let's get going here. We have about 20 people on the call. I think we had maybe 40 or 50 people sign up for the webinar, so I think there'll be more people joining us. My name is Ben Driggs, for people who don't know me. I am the president of Navigate Financial, And on the call with us is DJ, who also works here at Navigate Financial. DJ will be handling the Q&A and the presentation, some of the technical things behind the scenes. So we appreciate DJ helping out with that. If you have any questions, please send a question to the Q&A. And if you have any questions to start, go ahead and send them now. Otherwise, I will go ahead and start the webinar. We plan on a 30-minute webinar. We'll have about 20 minutes of a presentation, followed by 10 minutes of Q&A as a format. So again, thank you very much for taking the time to meet with us today. We're excited to be sharing today's topic, and also we will be doing these webinars once a month, the first Thursday of every month. The next Thursday in July, that's July 4th. So that will be Thursday, July 11th. And we'll send you more information about that as time goes on. So let's go ahead and start. We're good, DJ? Yeah. So today we're going to be talking about what we do in this high interest rate environment, which we find ourselves in today. But as a beginning, I wanted to give some background, some context to where we are historically, because we know that interest rates are high right now. They've gone up dramatically over the last couple of years. But let's get some historical background for some context. So looking at the long-term interest rates over the last, since they started looking at interest rates in 1971 on the 30-year mortgage, if we look at the 30-year mortgage interest rate as a reference point for overall interest, then since 1971, the average has been 7.7. That might surprise people on the call, on this webinar today, because that's even 0.6% higher than today. So today we're looking at about 7.1, and although that feels very high because they've been so low, historically we're actually below the long-term mortgage interest rate. I think that's relevant because if we're thinking that the default needs to go back down to 6.5432, that's probably an unrealistic expectation. That marked from 2008 to 2022, a 14-year time period that was unique for low interest rates. I think it is fair to anticipate that over the next few years, we're moving into a higher interest rate environment, and we're going to sit there for perhaps a little longer than people would want. Now, this is helpful if you have money sitting in the bank because you can get a high interest rate without a lot of risk. So this is helping people who have cash. Of course, it is hurting people who are trying to get into homes and who have credit card debt or consumer debt. So high interest rates is a double-edged sword, but I'd say in general, most people would prefer a low interest rate environment. Certainly people who have a lot of debt working against them, which tend to be the lower income rather than higher income, these high interest rates are having a disproportionate challenging impact on the lower income in our country. So that gives you a sense of the interest rates. If you look at, here's a chart over the last, here's a graphic of what I just explained. The average is 7.7. You can see in the 70s and 80s, things were extraordinarily high. And then we have a leveling period in the 90s and up to 2008-ish, and then things start to go down, and we're back to roughly where the long-term average is, if not slightly below. The next slide is a little closer oh, I don't know, maybe we dropped that. We had another slide in the presentation that looked just at the last about 15 years. And you can see in the last 15 years, they've been really low. But anyway, next slide, let's talk about inflation, because there's a high correlation between inflation and interest rates. So let's talk about inflation compared to a long-term average. If we look at the long-term average of inflation, it's actually about on par with today compared to long-term averages. Dating back to 80 years ago, World War II, a lot of volatility with World War II. And then in the 50s, 60s, things mellowed out. Then you had dramatic 70s and 80s with inflation. And since about 1984, the last 40 years, inflation has been relatively modest. You see it drop down there in 2008, where we had deflation. Very scary. We don't want to see deflation. So a lot of people say, they're afraid of inflation, but there is a natural rate of inflation. As like here, it's 3.7 since 1944. Right now we're at 3.4. So inflation should not be something that we're too afraid of. There is this natural rate. That's why it's important to make sure you're trying to get some money either in cash or in the stock market to keep up with that inflation. Otherwise, you're going to get left behind with inflation. Moving to the next slide. This is, maybe it's on this one with the inflation over the last few years. You can see it's a little dramatic over the last couple of years. But now we're kind of getting back to historic averages. So what is the cause of the high interest rates in the last couple of years? There are a few things that were building up over the last decade that gave rise to the high interest rate environment in 21, 22, 23. It's all due to inflation. So inflation was caused by 4 or 5 major factors. One of them is you had low interest rates for a long sustained period of time coming off the Great Recession. So after the Great Recession, people were able to borrow, and a lot of people leveraged that. They could say, hey, I could borrow, I can buy a house, I can buy a business, I can finance things low interest rate. So they poured a lot of money into the financial system. That is inflationary. We also had things coming off COVID. There was a lot of money pumped into the economy. The government's put in trillions of dollars to prop up the economy during COVID. That was inflationary. We also have a strong economy, so unemployment is low. That is inflationary. And we also have high wages. The single biggest component to inflation is high wages. So when wages are strong, and in the last couple of years, wages have been, the wage earners have been in the driver's seat, and so they've been able to command a higher price. As wages go up, people spend more money, and as I just mentioned, the single biggest ingredient to inflation is high wages. So if you want to stop inflation, the unfortunate challenge is that in order to stop inflation, we have to bring unemployment down, or employment down. Unemployment needs to go up. And that's what the Fed is trying to do: raise interest rates, slow things down. This is going to be good for almost everybody unless you lose your job. And if you lose your job, it's obviously not good for you and your family. So let's go to the next slide. As I just mentioned, how we fight inflation, the Federal Reserve Bank is the biggest player in impacting inflation and the fight against inflation. The Fed raises interest rates to slow down the economy. Interest rates rise. People are less inclined to borrow money. So therefore, they spend less money, invest less money. Less borrowing leads to less consumption and spending. And so the economy softens and leads to less inflation. So that's what the Fed is trying to achieve. And so far it's doing a pretty good job. Any questions? By the way, raise your hand if you have any questions. That is kind of the first part of our discussion. As we pivot, and that gives the background. So we say, okay, we're in what I would consider to be in a rather neutral position in terms of inflation, higher than what people would want, but not particularly alarming. Interest rates are higher than what some people would want. Other people are taking advantage of it, but not particularly alarming from an historical standpoint. The best case scenario would we have inflation coming down, which is happening. We have interest rates coming down, which is probably going to be happening, and we don't go into recession. And if those three things can come into play, arguably the Fed has really put together a masterful scenario that's really the best case. So let's talk about investing. And the next slide will show that we have, in investing, there are roughly three areas of the financial system. So everyone on this call, everyone in America, I would hope would understand this slide, perhaps more than any other slide. There are three areas of the financial system: the cash, which is your banking system, the bond market, and the stock market. And how we as investors navigate moving those pieces around is really the bulk of what we're going to get as an investment return is the decisions, or based on the decisions we make on this asset allocation. So asset allocation, you've probably heard that term before. There are a few different levels of this. I would call this the master asset allocation, meaning how much do you have in the banking system? How much do you have sitting in cash? How much do you have in bonds? How much do you have in stocks? Now, there are sub-asset allocations. For instance, in stocks, I want international stocks, domestic stocks, large stocks, growth stocks, dividend-paying stocks, etc. In the bonds, you could say, well, I want government bonds, or I want corporate bonds, I want long duration. There's a whole science and set of options in each of these categories. And we're going to talk about cash here in a minute. But from just a general standpoint, we're trying to decide bucket 1, 2, or 3, and what's that combination. Now, fortunately, today, we're in a very, very good situation for all three buckets. So investors who have money in savings, or actually having that money invested, should feel pretty confident right now. Things are going about as well as I can imagine. So let's talk about cash. We talked about cash. I'm going to use cash and cash equivalents. So I've broken this down into two different categories. The first is cash that you would have in a banking environment. So the first bullet point is I've lumped all those that are really low interest and maybe even no interest, like a checking account, bank deposits. You put your money over at the bank, it just sits there. Those interest rates, you can count on basically nothing, maybe 0.1%, 0.2. Say money market, savings account, call it what it is. They have slight differences, which we don't need to talk about. But the point is, those are your very low interest bearing accounts sitting at the bank. So if you have any sizable amount of money sitting at the bank, you're probably in that first bullet point. And I talked to someone recently and he said, well, I have it in a money market account, and that's good. Well, we're going to talk about the money market fund in just a minute. A money market account is an interest-bearing account at the bank that only gets you maybe 1% these days, if that. A money market fund is technically an investment account. So let's talk about that for a second. If you have your money sitting in the cash in an investment environment, in an investment account, brokerage account, IRA, something like that, then you also have this first category. They're called brokerage deposits rather than bank deposits. Same concept, just sitting there. If you have, $10,000 in a brokerage account, you've invested $9,800 of that money, and you have a couple $100 that you haven't invested. That would be brokerage cash or bank deposit. The brokerage firm will usually put that in some sort of interest-bearing account, but it will be nominal. You can expect to earn basically no interest on that money. So those are the same. The second category, I need to come back to high yield savings account in just a minute. The second is a money market fund. The money market fund is something you definitely want to consider, and you're going to get that in an investment environment, not at the bank. A money market fund is now giving maybe 5.1, 5.2%. That is considered to be a cash equivalent. It's technically not cash, but it is considered to be you can call it cash without having some, it's appropriately called cash, but technically it is not cash. It is not FDIC insured like your money sitting at the bank, but it is still should be considered to be safe, conservative money. I forgot to mention up above, cash in a bank account. The second category is high yield savings account. So we talked about that first bullet point, not much going on there. The second one is actually kind of a unique category unto itself. It's a bank instrument, not an investment instrument. It is truly bank. It is FDIC insured up to $250,000. And these are being promoted and sold by online banks, predominantly like Ally Bank, for example. So you would go online because they don't have the overhead of, like Wells Fargo Bank doesn't sell those. Chase Bank doesn't offer high yield savings accounts. But if you go to Ally Bank online, you can get maybe 4.123% these days. Quite an attractive rate of return for FDIC insurance. But the thing is, you have to open up an account there, and that might be a nuisance. So if you have your money sitting at Chase Bank or Wells Fargo Bank or something, if you want anything, you've got to either go into a brokerage environment, or you've got to go over to a bank, an online bank that offers a high yield savings account. And again, that's low fours today. If we go back down to the investment account, money market, you're looking at low fives today. You pick up maybe 1% more by going into a brokerage environment. And let's talk about CDs for a minute. CDs can be offered both by the bank or in a brokerage environment. When you buy a CD at a bank, that is called a bank CD, and it is issued by the bank. So if you walk over to your bank and you say, hey, America First Credit Union or, AB, Chase Bank, I want to buy a CD. They will give you the CD that bank offers. And it has FDIC insurance, very safe, of course. And you tie up your money. Although if you need to bust out of a CD, the penalty is very nominal in most circumstances. I wouldn't be too worried about that. But there is some penalty for tying up that money. So your bank CDs and your brokerage CDs now are coming in, depending on how long, 3 months, 6 months, 1 year, 2 year, roughly 5%. I think the 1 years these days are maybe 5.4, but then the banks reserve to pull them back after about 6 months. So again, you're looking in that low fives for the CDs these days. So you might say, well, if I have a CD in the low fives or a money market fund, not account, I have a money market fund at low fives, maybe I ought to go with the money market fund, which has daily liquidity. CD is going to tie things up a bit. That's something that we can talk about online. Now, the brokerage CD is a little different. The brokerage CD, and that's what I work as working through a brokerage environment. So instead of being connected to one bank and someone says, hey, I want to buy a CD, or we want to manage a client's cash in the most optimum way, they do not have an immediate need for that money. So we'll go shop the entire market and we'll choose from thousands of CDs being issued from different banks throughout the country. We'll run a filter and say, hey, there's a CD out of Indiana State Bank or something like that. And we're able to buy chunks. Let's say you had a big amount, like $1 million, you buy 4 of them, 250 times 4. And that way you get FDIC insurance on all 4 of them. And I would say all other things being equal, brokerage CDs might be a little better simply because you're shopping from a bigger basket as opposed to just walking down to your bank and maybe you get lucky. Maybe your local bank is really competitive. But I think brokerage CDs are offer daily liquidity. It says it's a 1-year CD, but you could just say, hey, I want to sell it. And you sell it at the going rate at that time. Again, you might make a little money or lose a little money if you have to sell it before it matures, but very little impact there. Here you look at the long-term CD rates on this slide. Average 3-month CD rate since 1964. That's what, 60 years. In 60 years, you're at 5.1. CD rates right now at 5.4. So this is your cash. We're kind of long-term in the long-term average. And so if you think that eventually we're going to come back to averages, we might be in this high interest rate environment for a little longer than anticipated, or maybe for many years to come. We don't know. But that gives you some historical context. So that is cash. Let's take just a minute. It is 23. Let me do bonds, and then we'll ask a couple of questions.
Now, real quick, before we move on, there is one quick question that was thrown in here. Is it better to have a brokerage deposit, bank deposit, and keep your money safe, or invest it in the stock market?
Okay, we'll talk about that in a minute. Yeah, that's a big question. And that gets back to the question, do I have my money in cash, bonds, or stocks? Which is hours-long discussion. That's really, your question is the fundamental question that investors around the world are asking every day. Where do I have my money? And today, because interest rates are so high and bonds are so high, or high, they're attractive. And bonds are relatively conservative too. You can, if you're nervous about the stock market, you can say, hey, I can get a 5% rate of return with little to no risk. You couldn't have said that 3 years ago. So since 2008, from 2008 to 2021, 2022, there was zero money. You were falling behind on inflation. There was no money sitting at the bank, small amounts in the bond market. And so that forced investors over into the stock market, which of course is more up and down. In the long run, you make more money there, but it's more volatile. So in the last couple of years, money has moved back. Trillions of dollars have moved back into the cash markets and less so to the bond markets. But they're saying, hey, if I can get 5%, no risk, that's where I want to go. But where do we go from now is a different question. So before we answer that, let's talk about bonds. For today's conversations, for the sake of time, we're just going to mention a few things about bonds. They generate interest like cash. If you look at the long-term history, which we'll show on the next slide, over time, they tend to behave like cash, but a little more because it is technically an investment. It is not FDIC insured. And because you're taking on some risk there, some market risk that you potentially could lose some money, then you're rewarded by getting maybe 0.5 to 1% in the long run better in the bond market. Now, importantly, the next 3 points are very important to understand. When interest rates are stable as they are at this moment, bonds usually pay a little more than cash, as I just mentioned. All other things being equal, bonds a little higher. When interest rates go up, bonds do poorly. When they go up dramatically, as we've seen in 22, 23, the last couple of years, the bond market goes down a lot. Or, I mean, for the bond market, it's down, a few percent is a lot. So that the last couple of years have been very painful for bond investors, which are a really big bulk of the entire world financial system, perhaps the largest of the 3, I'm not sure in terms of size, but that's where governments have most of their money. This is where pensions and insurance companies, trillions and trillions of dollars were lost as interest rates went up. But interest rates have gone up. Now they're staying there at this, they've stabilized. So at this very moment, the bonds are paying slightly more than, well, it's about a tie at this moment. When interest rates go down, bonds usually go up. There's an inverse correlation. So on the next slide, well, just know that we'll talk about that in a second. So the bonds, here's a long-term slide that you can see this 5.88. We're now at 4.4, a little lower than long-term average, but the 5.88 long-term average is a little better than the 5.1 in your CD market. But those follow. So let's finish the presentation with a metaphor I call the ship metaphor. So imagine a big barge coming into the dock. Well, the captain of the vessel has to make a decision many miles out at sea as to when they turn off the engines. If they turn off the engines too late, they're going to slam into the dock. If they turn off the engines too soon, they're not going to get to the dock. They're going to stall at sea. If they do it just right, they'll have a nice smooth landing. So that's scenario 1, 2, and 3. So each of these has a corresponding investment strategy associated with it. And that's what we're going to be talking about in the last 2 or 3 minutes. So let's go to scenario number 1. Scenario 1 is the most optimistic one. That is, the economy's going to slowly soften. That is the scenario that is playing out as we speak. Investors are very happy. Stock market is up. Bond market is kind of flat year to date, but recently is up. It is up as evidence is growing that the economy is starting to weaken, and interest rates are still high. Right now, everybody's making money in all 3 buckets. So a combination of cash and bonds, and more generally on the second slide, if we're just talking cash, you would go cash and bonds. More generally, at long-term IRA, 401k, you're going to have some combination of cash, bonds, and stocks. Scenario number 2 is we're going to go into a recession. There's not a lot of evidence that that's happening, but that could. Things are starting to weaken underneath the surface. Things could unravel. And as we all know, things can sometimes unravel faster and more worrisome than we anticipate. If that happens, we're going to have the economy going down relatively quickly. Interest rates will come down. Unemployment will go up. People are going to lose their jobs. Bummer, bummer. But at least inflation is going to come down, if that is any solace. But that's good. So if in cash, we want to go with bonds because bonds do well when interest rates come down. So if we're pessimistic about the economy, we would want to go with bonds and cash perhaps, and stocks too. If it starts to soften, the stock market will do well as well. And more generally, again, bonds and stocks if the slowdown isn't too aggressive. The last scenario is we stall at sea. They didn't keep interest rates high enough for long enough. The economy is still too strong. Inflation remains high. Interest rates remain higher the longer. We just have a really hot economy, which is good for jobs and things like that. A lot of good things about having a hot economy, but it's not good if you're trying to get a house. It's not trying, good if you have a lot of interest working against you in credit cards and consumer debt and things like that. The cash management recommendation, stay in cash, enjoy the CD rates, enjoy these money market funds, the high interest savings accounts, these kinds of things. Just relax and enjoy nice interest. And the same thing with the general, it'd be cash and stocks too. If it doesn't go, if the economy just doesn't accelerate too much, you'd probably want to avoid bonds in this situation. It is 10:31. That wraps up our thing. We have one or two questions, I think. The last slide here, navigating can be difficult. We invite you to reach out to us if you have any questions or you like our help. And we also invite you to follow us on Instagram, Facebook, these types of things. We're going to be having our next webinar on Thursday, June 11th at the same time. And DJ, was there one or two questions?
Just one more question that was written in here, if you can answer it real quick. So is there any benefit to a CD over a high yield savings account? If the high yield savings offers 5 to 5.5%, would there be any benefit to a CD over that type of account?
Okay, so the CD would, if you could get a CD that locks up and guarantees that, say 5.4, the high interest, if you can get above 5% on the high interest, I think that would be really attractive. I was looking at those earlier today, and most of them were coming in low 4s. But if you got a high interest savings account at a bank, FDIC insured, that's going to be good. But what happens is the economy starts going down, that you're going to start going down. That's like going down every single day. So a year from now, you might be at 4% or 3% as interest rates go down. I would say that the CD is probably better because you can grab a 1-year CD and that is going to lock in that interest rate at a higher time period. So close call, you'd probably go with a CD because if interest rates start to go down, your CD is going to hold its value and you can guarantee a higher interest rate for a longer time period, all other things being equal. Great question.
And Ben had mentioned that, the next webinars, he had said June. It's actually July, so July 11th. So we'll hopefully you guys can register for that. If on Instagram, we'll be sharing it. We'll be posting about it. And another reminder, you may have other questions or want to talk. We will send out a link to our calendar to be able to set up a time where you can sit down and talk with Ben about your specific situation. You may have certain questions that pertain personally to you. And in that case, it might be worthwhile to sit down and talk with Ben about those. So we'll send out that link. So feel free to book some time on his calendar to have those conversations about the high interest rate, environment, CDs, high yield savings accounts, brokerage CDs, all the stuff we've been talking about today. So.
Thank you very much. If there are no final questions, we'll see you hopefully in a month and have a wonderful weekend ahead. Take care.